So you've got some money to invest. You face this huge choice, right? Do you try to find the next big thing, the next Amazon, or is there a simpler, maybe even more powerful way to grow your wealth? Well, that's exactly what we're breaking down today. This quote from investment legend John Bogle, man, it just gets right to the heart of one of the biggest debates in finance. It's the core idea behind a really powerful strategy we're going to unpack, and it perfectly sets the stage for two very, very different ways to think about building your wealth. You know, every single investor, whether you're just starting out or you've been doing this for years, faces this exact dilemma. When you put your money into the market, what's the actual goal? Are you hunting for that one incredible stock that's going to change everything? Or are you playing a totally different game?
Yeah, this isn't just about different types of investments. It's really a clash of worldviews. One philosophy says, I can outsmart the market, and the other one says, you know what? The smartest move is just to join the market. So let's meet the contenders.
Okay, so the two paths are called active investing and passive investing. You've probably heard these terms thrown around, but what do they actually mean when the rubber hits the road? Let's break them down, starting with the more hands-on approach. So this is what most of us picture when we think of investing, right? It's the world of deep research, of analyzing companies and making these calculated bets. You're the manager, you're calling the shots, and your goal is simple: beat the average. You are officially hunting for the needle.
Passive investing is, well, it's the complete opposite. Instead of trying to find that one winning stock, you buy a fund that holds pretty much all the stocks in a big market index. Think something like the S&P 500, which is basically the 500 biggest companies in the US. You're not trying to find the needle anymore, you're just buying the whole haystack.
And this slide right here, it just nails the core difference. Active investors are trying to beat the market. They want a better return than everybody else. Passive investors, they're perfectly happy to be the market, capturing the growth of the whole economy. Just two simple phrases, but they represent two completely different worlds. Okay, so now that we get the philosophies behind them, let's actually put them in the ring. Let's see how they stack up against each other on the things that really matter to you as an investor.
Let's break this down. First up, risk. With active investing, you're concentrating your bets on just a few stocks. That means higher risk, but also the potential for a much bigger reward. With passive, you're diversified from day one, spreading that risk out, which naturally lowers it. Then there's time. Active investing, it's kind of like a part-time job. It takes constant research. Passive investing is famous for being a set-and-forget-it deal. And finally, the goal, like we just saw, is totally different. One is trying to outperform, while the other is just designed to match whatever the market does.
But here's the kicker. This is the statistic that really shocks most people. You'd think that professional stock pickers, the people who do this for a living, would consistently beat the market average, right? Well, the data shows the complete opposite. Over the long haul, the vast majority of these professional, actively managed funds actually fail to do better than a simple, cheap market index fund. It turns out just buying the haystack has been a surprisingly difficult strategy to beat.
So after all that, which strategy wins? Which one's better? Well, the answer is, it totally depends on you. There's no single best strategy for everyone. The right choice really comes down to your personality, what your goals are, and even your lifestyle. So if you're someone who genuinely loves digging into company reports, if you like following market news and you have the time and the stomach for the ups and downs of individual stocks, then yeah, the active path might be a great fit. It's really for the hands-on enthusiast. But on the other hand, if your goal is just to build wealth steadily over the long term without it becoming a second job, well, passive investing is incredibly powerful. You get instant diversification, and it's designed for people who'd rather focus on, well, other things in life. So look, here is the absolute most important takeaway from all of this. Don't let anyone tell you there's only one right way to invest. The best strategy is just the one that fits you, your goals, your personality, and frankly, the one that lets you sleep at night.
And if you're sitting there wondering, okay, where do I land on this spectrum? We've got you covered. To take the next step, pop over to the blog. We have a guide that breaks down which of these strategies might be a better fit for your personal risk profile.
And that brings us right back to that big question from the beginning. Now that you understand the two paths, what kind of investor are you? Are you setting out to find that one specific needle in the haystack, or do you see the wisdom in just buying the entire haystack? The choice is all yours.